Israel versus Iran, it's all over the headlines. People are panicking. Everyone's asking the same thing. Is World War III about to begin? And if it does, what happens to the stock market? Let me tell you this up front. Yes, if World War III breaks out in the coming days or months, the stock market will absolutely crash. There's no doubt about it. And that leads to a question everyone is thinking right now. Should I pull my money out of the market and invest somewhere else? Honestly, that question hit me too. So I did what I do best. I dug into history. I researched past global crises, wars, invasions, and economic shocks. And what I found might actually surprise you. Let's take a look at what history tells us, because the stock market has faced chaos before, and there are some patterns we can learn from. Let's travel back to December 7th, 1941. Pearl Harbor just got bombed. America's officially in World War II. People are freaking out, and I mean really freaking out. So what happened to the stock market? The market dropped a whopping 3% the next day. That's it. 3%. I've seen bigger drops when Elon Musk tweets something weird about Dogecoin. But here's the kicker. Within 1 month, the market had completely recovered. 1 month! During literally one of the biggest wars in human history. Now, if you think that's weird, buckle up because it gets weirder. 1962, Cuban Missile Crisis. The world is literally seconds away from nuclear war. Kennedy and Khrushchev are playing the world's deadliest game of chicken. Everyone's building bomb shelters. The market drops 7% in 4 days. Sounds scary, right? Well, it recovered in just 10 to 12 days. Now, here's where it gets really interesting. When Russia invades Ukraine, the oil prices shoot up like a rocket. Gold goes crazy. Everyone's talking about World War III again. The S&P 500, that's basically the entire U.S. stock market, dropped 2.6% on invasion day. People are selling everything, running for the hills. But plot twist, within 1 month, the market was trading higher than before the war even started. Higher! Even Bitcoin dropped 8% on the invasion day. Then guess what? It bounced back too. It's like the market has this weird superpower where it freaks out for a hot second, then goes, actually, never mind, we're good. So now you may be thinking, I'm smarter than this. I'll just sell everything now and buy back when things calm down. Well, let me break this down with a simple hypothetical scenario. Meet our 3 fictional investors, each contributing $500 monthly to an S&P 500 index fund from 1985 through 2024. But each followed a different investing strategy. This is Emma. Emma was the genius. She possessed supernatural market intuition, investing her $500 only at the absolute lowest points of major market downturns. She captured every significant bottom perfectly. Next, we have Jessica, the unlucky investor. Jessica had consistently poor timing, investing her monthly $500 right before every major market crash. Her timing couldn't have been worse if she tried, but she kept on investing. And finally, we have Maria, the set and forget investor. Maria took the simplest approach. She just put $500 into the market every month for 40 years, no matter what was happening. War, peace, zombies didn't matter. No market analysis, no timing attempts, just unwavering consistency. After nearly 40 years of investing, these are the results. Emma, with perfect timing, ended up with $3.3 million. Jessica, with terrible timing, got $2.1 million. And finally, Maria, who is consistently investing, ended up with the most amount of money, $3.5 million. So how is that even possible? Let me explain. Maria's victory reveals a fundamental truth about wealth building. Her money was continuously working for her. While Emma waited for perfect entry points, Maria's capital was already growing through compound returns. Even with superior timing, Emma had less money invested during crucial growth periods. Jessica's story is equally revealing. Despite her horrendous timing, she accumulated over $2 million by doing one thing right. She never panicked and sold. Her $240,000 in contributions grew to over $2 million because she remained invested through every downturn. This comparison illustrates why time in the market consistently outperforms timing the market. The mathematical power of compound growth, combined with regular contributions, creates wealth more effectively than even perfect market timing. The worst thing you can do, even worse than terrible timing, is to stay out of the market completely. So if you panic and sell during a crash, you almost always miss the rebound. You have to be right twice, selling at the top and then buying back in at the bottom. But even if you could do that, which no one can, you still might lose to the person who dollar cost averages because they'll end up with more money over a longer period. Look, I don't know if we're headed for World War III. I'm not a fortune teller or geopolitics expert. But I do know this. Trying to time the market around scary headlines is like trying to catch a falling knife while riding a unicycle. Possible? Maybe. Smart? Definitely not. So here's your homework. Don't panic. Keep investing consistently. The world might feel like it's on fire, but your investment strategy doesn't need to burn with it. If this helped calm your financial nerves, smash that like button, subscribe for more reality checks, and check out this video popping on the screen to understand inflation.